Hi, this is Timothy Schutte with Exit Realty and Associates. Welcome back to my video blog. The Fed's just lowered the intermonetary fund rate between the banks charge each other another 0.25% here this last December 10th. That's the sixth rate cut they've done since they started raising rates post-COVID era. And so that sets that rate at a 3.5 to 3.75 range. Now that is just the rate that banks charge each other. It does signal what investments and bonds are safer as an investment. And what we should see, and what we typically do see, is mortgage rates tend to follow. But the last 5 Fed rate cuts, rates actually went up in the short term and then come back down slowly thereafter. What's more interesting to me, or something that is a good sign, is that the Fed is going to start buying about $40 billion a month of bonds, which those are mortgage bonds, and that gives a signal that those are a safe investment. It also pushes mortgage rates down, and this is the first time that with the Fed funds rate that the mortgage rates dipped right during or right after the announcement that the Fed was going to reduce rates. And so what's that signal? Well, it signals that I think mortgage rates are going to be slowly coming down, that rates are going to be better coming into next year. How much to be determined, because the Fed is pretty hawkish. They're signaling that they're not going to be as many rate cuts next year, but it all comes down to what the economy is doing and what inflation looks like alongside of employment. So if unemployment goes up, they're going to say the market's slow, that they want to be able to stimulate the economy by reducing rates further. This is all a little bit complicated, but if you're a buyer, here's what I do see is the Fed committed to 3 months of those bond buying times, which I think will push those rates down a little bit. And that might be your window. That might be your window for the best rates for the year. It might not be, but I think it's going to signal a little more affordability for mortgage payments. With how complicated this can be and what it looks like, and how the fact the Fed does change their mind after they look at data, and the data that they've had has been pretty weak for the last few months because the government shut down. Please feel free to reach out. We can discuss this further. If you're looking to purchase, be happy to know a bunch of great mortgage lenders that follow this closely as well. This is Timothy Schutte with Exit Realty and Associates.